Welcome to Market Matters, our markets podcast on making sense, the hub for JP Morgan Corporate and Investment Bank podcasts. In each episode of Market Matters, we discuss the latest news and trends shaping markets today.
Hi, I'm Eloise Goulder, head of the Data Assets and Alpha Group here at JP Morgan. And today I'm so pleased to be sitting down with Kate Finlayson, who is head of FICC market structure and liquidity strategy here at JP Morgan. And it's worth noting that Kate and her team are regular features on this Making Sense Market Matters podcast series, so many of you may be familiar with her content. But I'm really looking forward to diving into some of the differences between FICC market structure and what we see within equities. So Kate, thank you so much for sitting down with me today.
Hi Eloise, it's great to be here.
So Kate, can we start by setting the scene, and can you explain what your team's mandate is and where you sit within the business here at JP Morgan?
Sure. Our team focuses on what could shape the provision of liquidity and the access to liquidity in global markets, whether that's driven by formative regulatory proposals or the microstructural developments, trading techniques and technological advances. Team has a broad remit covering fixed income, currencies, commodities, and extends across both cash and derivatives. And we speak with our clients about what all these developments actually means for them in a business context.
Thanks, Kate. Well, you certainly have such a broad remit across all of those asset classes, all of those regions, cash and derivatives. So how do you determine which areas to focus on at a given point in time?
Yeah, it is rather broad there. We zero in on what could drive change in terms of how market participants interact, engage with liquidity, or where we observe distinct patterns or variances in trading techniques emerging. We are, of course, very familiar with the larger pieces of regulation, MiFID II, MiFIR, Dodd-Frank, and so on, and how these have shaped how you need to trade, what you need to report, etc. We have certainly had a lot of regulatory proposals even this last year. And ultimately, we have to assess what's impactful in terms of these proposals. Will it influence when you need to report a transaction? At what size a trade is considered block and therefore has to be executed on a swap execution facility and RFQ to 3 instead of RFQ to 1? What market information leakage may occur as a result of various transparency requirements, both in the US and Europe, for example? And that's just a small flavor of the regulatory side. But actually, that's just one factor driving change. As technology and automation and workflows advance, and a focus on efficiencies from both the buy side and the sell side, what does that mean for data aggregation, price formation, distribution, data analytics? Where do we see more on-screen trading in certain commodities, for example, in European gas, and the development of electronic trading of emission allowances? Where do we see innovation in municipal bond markets? Some really interesting dynamics there. And lastly, I'd say, as investors search for yield, there's obviously been a focus on emerging markets. So what do we see changing in interest rate swaps or non-deliverable forwards and how they're traded? The investor base and access routes for some of these emerging markets. Our clients cover multiple asset classes, and so we do the same.
And coming back to your point on electronification, the idea that markets are becoming more and more electronic and that more and more data is becoming available, my assumption is that FICC markets as a whole are further behind equities in this process. First of all, would you agree with that? And second of all, where have we seen pockets within the entirety of your space where markets have become quite electronic and data-driven at this stage?
Yeah, so I think an interesting anecdote was when I first started doing this role, approaching 10 years ago now, there was a bit of a running joke that my job title was an oxymoron because there were no structure in fixed income markets. Things have changed, right? Things have moved on considerably. I do think it might be helpful for us just to set out what we mean by electronification, because there can be different interpretations in the OTC space, fixed income markets. I often reference the Bank of International Settlements, which considers electronic trading to include electronic quote requests, the quotation of prices or dissemination of trade requests electronically, and the matching, negotiation, and execution of trades through an electronic system. That's how they phrase it. And when you look at the OTC space, I think foreign exchange is probably a good place to start in terms of the more electronified pockets. If we use FX Spot as the prime example there, highly electronified, we have the increased use of algorithms, advances in the types and the sophistication of the algorithms that are accessible and used, and the tools available for transaction cost analysis, right? Pre, at, and post-trade data that's available to assess the performance of the algos. FX derivatives would follow in terms of the electronification. And then moving on to bonds, we have streaming in both treasuries and European government bonds, EGBs. And we have algos for US treasuries with data analytics. So we've seen great advances when it comes to corporate credit. So auto-quoting, different protocols utilized, an increase in portfolio trading, where you have advances in the data analytics available to guide you on where best to execute, how to optimize to solve for transaction costs, and so on. And so more data has become available. We've seen more systematic strategies being implemented in credit markets as well. So many different pockets across both developed and emerging markets, cash and derivatives, the full spectrum. We definitely have seen those advances.
That's really helpful to hear where you've seen these pockets of development across FX cash, FX derivatives, and then various bonds and credit markets. And you mentioned there that with those changes and with greater data availability goes more systematic investors looking to leverage that data to arbitrage alpha opportunities. Do you see a really clear relationship between a market electronifying and then the emergence of those systematic strategies, and a really clear change in the type of clients that are generating alpha there?
No, absolutely. I mean, this is where there is data that's available. Then we have seen systematic strategies starting to be employed. Data provision is a byproduct of electronification, so it does lead on from that. And it's a very interesting time because it does offer a lot of opportunity for those strategies to enter that space for further development and accessibility in that particular asset class.
Thank you. So if we look at the opposite end of the extreme, pockets of your vast universe across FICC, where we haven't seen such electronification and therefore we don't see so much data, where are those pockets and what's stopping that development? What are the barriers to that development?
I think, look, some of the fixed income OTC markets, just to contextualize here, are far more heterogeneous than cash equities. The size of the trades, as you know, can be much larger, less standardized, more bespoke. It's a request for quote market in the main, so where there is an element of negotiation there. And for the larger size trades or the more illiquid transactions, while there are forms of automation there, like for portfolio trading, right, where you have blocks, having that customization and that interaction with your dealer and working to reduce market information leakage is key.
It's fascinating the way these asset classes are so complex compared to single security equities. And you mentioned their requests for quote RFQs. What's the relevance of them in this context?
Well, just by the very mention of that, it's indicative, right? So you get a client coming in asking for a quote on a particular instrument. There is still very much an inventory-driven element to fixed income markets. So having that discussion, it is a negotiation, and having that bilateral element of saying, look, we actually are a risk intermediator, we are warehousing risk, we have this inventory, and then pricing that up. And there is technology that's coming to the fore, particularly with portfolio trading, that allows one to say, okay, what do we have in the inventory there? What are we willing to price this as? But there is that element of negotiation, there is that bilateral perspective. And we've seen it when there are times of volatility where risk transfer may be the best route to ensure the price. And that's why I say relationships still matter, because from a bilateral perspective, from an OTC market, inventory-driven market, it is absolutely pivotal.
So right now, there's clearly still stark differences between some of these pockets within the FICC space and equities. But things are evolving. You said that you're tracking the regulatory landscape. You mentioned that technology is evolving. There are clearly competitive commercial drivers here as well. So when you put all of this together, where do you see the space, the market structure within FICC evolve over the next, say, 5 years?
I think electronification will certainly continue, and the focus on automation will intensify in an effort to introduce further efficiencies. And there are a lot of competing priorities, which I think it's important to bear in mind, and that's with respect to tech investment and operational process as well. So it's likely to be a gradual. And because of the time and the investment spent, it has to make sense, and there has to be value in the work that's undertaken. And in terms of data availability, there already is a lot of data out there. There is, of course, the formation of a consolidated tape taking place in the EU and the UK over the next year or two, one to watch. But it will be interesting to see, once there is this consolidated form, it is obviously crucial that the transparency regime that underpins that tape is appropriately calibrated so we don't have a negative impact on liquidity from information leakage, both for clients' trades. So it is certainly a key focus for us. But it will be interesting to see in 5 years' time how that has gone and what it has produced. So in summary, yes, moving in the direction of more automation, more electronification.
And when we think about the regulatory landscape, what is the direction of travel? What is the end goal from the regulatory perspective?
Yeah, I think broad brush, one would say that the regulatory goal there is to reduce systemic risk, enhance resilience in markets. What we look out for are the unintended consequences of some of these proposals and final rules. So there may be, from those rules, increased oversight. There may be more transparency. But we have to watch, as we were mentioning about consolidated tape again, that the provision of liquidity isn't impacted as a result of the increased transparency. So just being sure that that's nicely balanced. And where some are looking to enhance resilience of markets, we know that there are ongoing efforts in the US Treasury market, for example, following what the regulator identified as some dislocations. March 2020 cast your mind back. So looking at how do we enhance that market, we have now the final rules on the central clearing of US Treasury transactions, both cash and repo. Cash takes effect end of the year next year, and repo is end of June 2026. There is a significant amount of work involved in that. So I mentioned tech investment spend, but there's also prioritization of regulatory compliance in amongst all of this. I think that is where there are absolutely good intentions from the requirements and the rules that are put forward. One just has to ensure that as an investor community, as a sell-side community, we're engaged on these topics and we're part of that debate and discussion to ensure that the very good intentions that's done with these rules and regulations continues forward such that there aren't any unintended consequences.
And can we touch on the participants you have within your FICC markets? I mean, within equities, we've seen a continued emergence of systematic and quant investors really benefiting from the greater data availability that we have around single stocks. And at the same time, we've seen a real notable rise in share of volumes from the retail investor in US markets and in many Asian markets, particularly post-COVID. So, Kate, can you touch on the evolution in market participants in your markets and whether or not you've also seen the retail investor emerge?
Absolutely. There has been a change in terms of the composition of market participants in fixed income, for sure. We have non-bank liquidity providers. We have even asset managers that are looking to become a price maker in certain circumstances on their own as well. And also we have principal trading firms, PTFs, which, again, I mentioned the central clearing requirements for US Treasuries. They have certainly played an increasing role in the interdeal electronic Treasury markets. So there is absolutely a shift there. And systematic strategies that we touched on, we definitely see that in the credit space. But I would say from a retail perspective, because that's an interesting one, typically retail's been more associated with the stocks, right, with the shares on your side. But actually, I mean, foreign exchange does have a very strong retail market, has done for some time. If we look at corporate credit in the current rate environment, retail investors have been searching for yield, and so participation has picked up there. Certainly commodities as well. And they've been accessing that via fixed income ETFs, whether that's separately managed accounts as well for corporate credit. So we don't certainly engage with these customers ourselves. but there is absolutely a pickup in participation in some of these markets. And what that has meant tends to manifest in smaller ticket sizes and more done via electronic means.
That's great. So you've spoken about the different mix of investor types. What about the different mix of alpha strategies available and deployed in the context of all of these market structure changes?
Well, I'd say relative value strategies are still widely used. Relative value funds focus on pricing inefficiencies between certain fixed income instruments. So go long the undervalued security and short the overvalued related instrument. And treasury basis trades, for example, when an asset manager may be long the future to express a directional view or on duration or the yield curve, or possibly hedging, managing interest rate risk and gaining access to leverage, etc. On the other side of the trade is the hedge fund could be long the cash treasury security and short the future, and for those same reasons in the main. There's been a lot of focus by the official sector on the basis trade, generally looking at enhancing the resilience of non-bank financial intermediation sector. And there have been a number of Fed's notes on the topic, effectively looking at the use and the amount of hidden leverage associated with the basis trade. There was mention of a theoretical minimum haircut floor being imposed with the aim to reduce leverage in the system, albeit having an impact on pricing there. And the Financial Stability Board and other policymakers continue to focus on this, and we expect further developments on this. So definitely one to watch, but absolutely an existing and strategy that is utilised quite broadly.
Fascinating. My last question for you, Kate, is what's next? What will you be watching over the next few years as your space continues to evolve?
Well, if we were to push it out quite a bit further, because then we can do real blue sky. Maybe then we have developed, broadly utilised and fixed income transaction cost analysis tools. Maybe we have more automation, further advances with respect to tokenization. That is a key element of change that is certainly coming and developing as we speak. And maybe there's broader use of that and use cases, but then also liquidity with that as well. All the while we have this, so this is blue sky. All the while we have that, we're also fostering qualitative relationships that we have with our clients, which we obviously value greatly.
Fantastic. Well, many of those words sounded very equities-like from my lens.
Don't say that anywhere else.
TCA analysis, very familiar, obviously, here in the equities world. But certainly so much to watch. And as we mentioned at the outset, your space is so diverse across cash, across derivatives, across all of these different asset classes, looking at the regulatory landscape, looking at the liquidity landscape, looking at the microstructural landscape. It's obviously a fascinating area, Kate. So thank you so much for coming in and taking the time to give us a download on your world.
Thank you, Eloise. It's been a pleasure speaking with you.
Well, if you'd like to learn more about Kate's team's work, then please do reach out to your JP Morgan sales representative. Otherwise, if you have feedback or if you'd like to get in touch, then please do go to our team website at jpmorgan.com/market-data-intelligence, where you can reach out to us via the Contact Us form. And with that, we'll close. Thank you.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of JP Morgan's research department and do not constitute a recommendation, advice, or an offer or a solicitation to buy or sell any security or financial instrument. This podcast is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan.